so that we're all recording. Excellent. Well, ladies and gentlemen, we've got our another live webinar coming here from the IPS offices in Johannesburg. A very, very cold evening this evening, so I am sitting here with my jacket trying to keep warm in the office. Very exciting. You know, there's a tremendous amount going on in the market. Hell of a lot of information to try and give to you. I'm also going to give you a lot of resources to try and keep up to date because, you know, there's just so much information. And at the moment, particularly in the UK, you know, the idea and the name of this presentation is Crisis or Opportunity. It's the same presentation name I've had for the last couple of months. But, you know, nothing's changed. I think I met with Ian Fife this morning from the Financial Mail, the editor, and he basically said to me, you know, Scott, there's only one thing that is prevalent in all the markets at the moment, and that's uncertainty. And you know, what is the uncertainty and how does one manage that uncertainty? And what he said is, you know, there's uncertainty as whether the market's going to go up. There's uncertainty as whether the market's going to go down. And I think the real important thing is to look at those fundamental, underlying, important factors. Once you understand those, you can then make the decisions as to whether it's good to be investing, whether it's good to be sitting on the fence, or whether it's good to just watch what other people are doing. But without further ado, let's move across to our PowerPoint presentation. I want to basically take you through, and in the next sort of 40-odd minutes, take you through where I see the market, what's happening in the market, the basis of the information, and then we can start to make some good, you know, decisions based on that market. Before I get started, I just want to go to this particular page here. It's just going to show you roughly how a webinar works. For those of you that haven't actually used one before, you've got a little box on your right-hand side, which is over here, and that's where you can basically play around with the audio. You can ask questions at any time. I can actually see those questions come up, and then I will either try and answer the question now or I'll answer them at the end. You can also raise your hand, which, you know, if you've got a question and you don't really know what's happening, I can then basically look at it and I can see what's happening. So, you know, this really is very new technology. It's used extensively in America, particularly by companies like Deloitte. And trust me, you know, it is going to be the way of the future. And I think the most important thing for a lot of people to understand is that if someone had said to you 15 years ago, do you use email? And you might have replied no. Just because other people aren't using email, this is the way of the future. So without further ado, let's get started and move straight on to the next slide. Now, what I basically would like to do is get some participation. So firstly, what is everyone looking for? You know, what are you interested in when it comes to the UK market? And the first one that I would like to launch is, there's basically a poll which I've put out. Are you interested in new developments with long lead times? Are you interested in new developments which are finished? Standalone residential property that needs to be renovated, or even commercial property. Now, basically what you need to do is, if you can just click on the different options, I can then basically see what it is you're looking for, and it gives me quite a good indication as to what one is doing and how we can basically sort of tailor the event this evening. Okay, so I can see those results coming in. I'll give it another couple of seconds there. Okay, let's just another couple of seconds. Okay, ladies and gentlemen, well, let me crack on. Basically, we've got some very interesting results there, and let me just put them up so that you can actually see what those results are. So you can see that a lot of people are interested in new developments with long lead times, and then there's a splatterings of what different people are looking for with regards to property. Let's just do another poll quickly. If I was to ask you, what sort of areas are people looking at in London? So, you know, where are you specifically looking at? And, you know, I didn't have enough options there. Or are you looking outside London? We're going to go through this presentation tonight, and, you know, I'd like to sort of give you some feedback with regards to that. I specifically really think that people need to be targeting central London, or sorry, London, but within the M25 at the moment. I can see the results coming through here in terms of where different people are looking. Give it a couple more seconds, and there we are. Okay, very interesting where different people are looking. So if I close that poll, and I'm just going to share those results with you, you'll be able to see exactly what it is that that people are looking for. Very interesting. Central London, Southeast London, and Northeast London is where people are looking. For those people in Northeast London, you really need to be looking at some of our projects, particularly in Barking, and the Southeast London people, you need to be looking at the ones in Canary Wharf and around that area. Central London, we've got some exciting stuff coming for you. Right, well, let's move on now. So basically, I think the most important thing when one's trying to look at the London market is that it doesn't matter which daily newspaper you look at, which BBC report, the British press are fantastic at talking the market up and talking the market down. And I think that's very, very important to understand. And there's a tremendous amount of hype within the market. I personally believe now is the best time to invest in the UK since 1991. And I'm going to go through that in quite a lot of detail because, you know, from my perspective, life is all about understanding the opportunities. And I want to explain to you why I personally believe, and I've been saying this for the last 9 months, now is one of the fantastic times to get into the market. But you need to understand the fundamentals and you need to be making the right investment decisions. So let's look at it. The other thing that I think is important as a South African is that you've always got to take into account the devaluation of the rand. You know, statistically over the last 15 years, the rand has lost roughly 5% year on year against the pound. And you can see here some graphs that I got off Yahoo Finance recently. This is the 5-year graph of the rand to the US dollar. This is the 5-year graph to the rand to the pound. That's the rand to the Aussie dollar. That's the rand to the Kenyan shilling. And you know, you can really see a one-way trend. But you know, the Chinese have only one word for crisis and for opportunity. And I think to try and give you an indication of what I mean by that, when you take the currencies into account, when one looks at it, I've actually done a view here on the Aussie dollar, the rand, and the pound to the US dollar over the last 12 months. And what I think is very important to take into account is that you can see the green line is the pound, the blue line is the Aussie dollar, and the rand is the red line. But the important thing is that the pound has lost roughly 19.43% against the US dollar. It's lost, the Aussie dollar's lost roughly 17%, and then the rand has only lost roughly 6%. So, you know, even though a lot has taken place in the last 12 months, the rand is really, really strong at the moment, and it provides you with a great opportunity to be investing offshore, getting into those offshore assets, and obviously into those offshore incomes and buying yourself a property. So as a South African, I think that's something that's very, very important for you to take into account. As Napoleon says, the right information at the right time is 9/10 of any battle. And I think it's very important for you to take that into account and understand it, because we basically are now going to provide you with that information. So there basically are two different indices which I use. The Financial Times Index, I believe this is the best indice. There's actually 7 different indices in the UK, but I believe this is the best indice because it takes into account all property within the UK. Most of the indices only take into account the mortgaged properties, and you need to understand that less than 50% of property in the UK is actually mortgaged. So what's important is this Financial Times Index, for me, is the most stable index and the one that one really needs to focus on. It comes out every month, and I basically got it yesterday. And what it's basically telling us is that the average cost of a property across the whole of the UK now is £197,000. Now in January, that's the same price as it was in January 2006. Now last month, the average cost was £197,000, 145. So it's gone up slightly, which was the same price as December 2005. The change in the last month, it's come down by minus 0.3%. It's the 6th month in a row where it's been less than 1% in terms of the drop. And it's the lowest drop since April 2008. The change in the last year has been 13.1%, and peak to trough, the market has now lost 14.7%. You need to understand that in 1991, that period from 89 to 92, peak to trough, it dropped by 16.4%. So we're not quite as bad as it was in that period, but it's really important to understand the associations between those periods and why I say it's the best time since that period to be investing in property. The nationwide index, which is one of the biggest mortgage providers in the UK, they say that the average cost of a house is £156,000. They say that in June the property price increased by 0.9%, and the change in the last year is down by 9.3%. The peak of that was actually April, which was around 15%. And very interestingly, whether you look at both indices, you're looking at peak to trough being around 15%. that's going to be very important later on down the line when we're looking at opportunities that are available. This graph here is from the financial index. It shows you the last 12 months and it shows you the monthly change. You can see that the worst time in the market, sorry, it's not actually showing it this month. The worst time in the market was actually November, where it lost 2.4%. But you can see steadily from December that the decreases per month have actually decreased. And what I believe is happening is that it is still going down in terms of the property market, but what one is actually, and I just want to put me on screen here so I can show you, it is actually going down. But I think the most important thing is that the property market is going down, but it's starting to level out. You know, when you go back to those numbers, it was up here 2.4, 1.6, 0.7, 0.6, 0.4, and now it's at 0.3. So it's really starting to level out. I'm not necessarily calling the bottom of the market, but you can definitely see that things are starting to improve with regards to it, basically. Okay, so if we bring you back here to the presentation, sorry, just 2 seconds. I need to get you back to the right screen. Okay, so you can basically see there that we're now. I think the important thing really, when one looks at it, is that from this particular graph, I would like you to go to ipsinvest.blogspot.com. Now I'm just going to send that to everyone. So that's www.ipsinvest.blogspot.com. Okay, and I've sent that to all of you. I'm going to go quickly to that page, and the reason I want to show you this is my blog or the IPS blog. I update this almost on a daily basis with all the latest information, and I think the important thing here is that all the notes that I'm going to be bringing to you are actually on here. So you've got the UK rental index, and then it's actually got the downloadable files. You've got the nationwide index, and then there's some information on Australia. But there's also the Financial Times index. So, you know, importantly, it's all there. It's all on the blog. It also actually updates you as to my Twitter posts. And I think that's fantastic. Between myself and my business partner, Brad Allen, you know, we're constantly updating this, putting all the latest information for you so that you know what you're following. And, you know, really, if you need one source of information, this is the place to go, basically. So let me just get back to the presentation there. And I think hopefully you've all got that. Now, let's look at what causes the property market to go down. And I think the two major things that have caused it, certainly in 1991 and the other collapses, have been, firstly, unemployment. Now, the interesting thing with unemployment is that the GDP in 2007 was 3%. In 2008, it was 1.5%. And they actually believe that this year it could go into negative growth in the region of between 1.5%. In 2007, 29.4 million people were in employment. But they've now had the worst recession since World War II. The economy shrank by 1.9% in the first quarter, the most since 1979. The unemployment rate has risen to 7.1%, up by 0.8% over the last quarter and 1.8% over the last year. 29.2 million people were in work in the first quarter of this year, and it basically means that roughly 157,000 people have lost their jobs, and it's down by roughly 295,000 people over the year. Now, that's obviously very significant, but I think the important thing is that the Bank of England has reiterated its plan to spend 125 billion pounds, 200 billion US dollars, to shore up the British economy and to make sure that the unemployment is not as drastic as it is. And you know, in terms of the world economy, there's a lot of interesting stuff happening. I was on BBC News this morning. China's come out with its recent reports, and they basically said that their GDP growth was at 7.9%, which is nearly where it was, you know, around the 8% mark, which is what they were hoping to achieve. So these stimulus packages are starting to work, and it's very, very important to take that into account because it obviously has a big impact on first world economies like in the UK. The second one that's most important is in 1991, interest rates actually rose to around 15.5%, and basically everything became very, very unaffordable. People just couldn't hold on to their houses. They basically were forced to sell, and you got yourself into a situation of negative equity. What you've got now in the UK is completely different. The Bank of England has reacted in the completely opposite direction. Interest rates peaked at 5.25% in 2007. They're now at 0.05%. It's the lowest it's ever been in the Bank of England's history over the last 300 years. And here you can see a graph over the last 25 years. And I think what's significant is that every major downturn in the early 80s, in the mid 80s, and also around 91 was where interest rates went up so dramatically. And yet now in 2009, you can see where the interest rates are here and how low they actually are for the man in the street. And I think it is so important for people to realize that the impact that that's actually happening, and that basically the man in the street, you know, has not been as adversely affected as they were in 1991. And yet property prices have still dropped, but you've got that cash flow component that I'll go into later. The big difference though, and people say to me, well, Scott, what is happening with the market? If interest rates have dropped so dramatically, why are people, you know, why is the market still struggling? And I think this graph really explains it very, very well. You've basically got the US, the UK, and Australia. The blue line is what the Bank of England or the Reserve Bank or the American Federal Bank has done. And you can see here how dramatically they've dropped the interest rates the Federal Bank has in America. You can see how dramatically they've dropped them in England and to an extent in Australia. The difference is the other colored graphs are those rates and how they've been passed on to the man in the street. And you can see that in America it's almost been non-existent, in the UK not really. And the reason that basically both those markets are floundering so badly at the moment is access to capital, and because these drop in interest rates have not been passed on to the man in the street. Australia, on the other hand, as you can see, has quite happily passed these on to the man in the street, and what that basically has meant is that it's shored up the Australian property market. And actually, interestingly enough, over the last 6 months, the Australian property market across the whole country grew by 4%. It's one of the best performing markets in the entire Western world, and the big difference between the economies, because the UK and Australia have the exact same fundamentals in place, it's just how the banks have actually been dealing with the process. And I think this graph is so important to understand. Then you look here at transactions, you can see what an impact this lack of finance has had. Over the last sort of 2006, you can see the heydays here in terms of transactions per month, up around 120,000 transactions. You can see how this steadily dropped off over 2008. And even though this year it has slightly increased, you know, it really is coming off a very, very low base. And that is why there's such a fantastic opportunity, because you've got motivated sellers and there are very few buyers in the market. If you look here in terms of, and to understand it, to get a 90% loan to value, in 2007, there were 3,000 different ways of borrowing as a first-time homeowner at 90%. Now there are only 103 different products. The rate as well in 2007 was 6.2%. The base rate was 5% at the time. Now you can borrow at 6.23% and the base rate is 0.5%. It's an absolute travesty, and that is the biggest problem with regards to the UK. And when the banks start lending, the wheels of the property industry will start to turn again, and that is when the real opportunity for the capital growth will come in. This graph here shows you the huge discrepancy between the house price deflation, but also, most importantly, the number of mortgage approvals. And I mean, to give you some actual statistics there, the mortgage approvals are the lowest level in 9 years. They're 30% of where they were in 2007. RICS, which is the Royal Institute of Chartered Surveyors, says it's the lowest level of sales in 30 years. It's 17% the volume of 2007. In November 2008, only 27,000 mortgages or transactions were actually approved. In March, it was 40,000. In April, it was 43,000. It is steadily increasing, but you need to understand that this is coming off a base from 1993 to 2007. It averaged 98,000 per month. So you can see how starkly behind the curve it actually is, and off what a low base this growth is. But it is certainly signs of green shoots of what's actually happening and how people are starting to want to get back into the market. Another important thing is that statistically transactions go up by about 35% from the winter into spring. This winter into spring, they've actually gone up 43%. So it's gone up dramatically, but statistically it does it every year. and now is when a lot of buyers come back into the market. In terms of the positive fundamentals, one of the first ones is the affordability. I think the most important thing is that house prices have grown twice as fast as earnings since 1990. But in 1990, when interest rates were at 15.5%, it was taking up roughly 50 to 60% of someone's monthly take-home. Now, the national average over the last 50 years has been around 38%. And in 2007, at the peak of the mortgage payments, the affordability was 32.5%. So what's happened at the moment is there's a huge lack of supply in the market. There's a lot of people that actually want to be buying. They're battling to get access to finance, but from an affordability point of view, with mortgages being a lot lower and also with regards to interest rates being a lot lower, property prices also being lower, affordability is some of the best it's been since the early 1990s. The next one, and possibly the one that is absolutely the most important, is the discrepancy between supply and demand. You know, there's a distinct difference between America and the UK. In America, there's an oversupply of nearly 1 million homes. Now, the problem with supply and demand is that property is a very simple game, and you need supply and demand. And in economics, if you've got a discrepancy between supply and demand, then the economy rectifies itself. Now, in America, supply is here by 1 million houses, and demand is here. And the only way for it to get back into equilibrium is for prices to come down so that there's more buyers in the market, and then effectively you're going to get that equilibrium. And they only believe that once prices have come down to a level where there's more buyers that can afford those property prices, that is when the market is actually going to shore up in the America. The big difference you got in the UK is that supply is there, but demand is over there. And the problem that the supply and demand is out of kilter, and it's actually getting worse. And if one looks at some of these statistics, that's important. The average population is expected to grow by 10% or 4.4 million people by 2021. Household sizes are actually dropping in terms of the number of people living per house. And it means that they need in the region of 208,000 homes per year. For the last 5 years, they've currently built around 170,000 homes per year. That's 40,000 homes short, or 15% per year. The government wants to increase this to 240,000 homes per year, or roughly 30%. And Gordon Brown, the Prime Minister, has promised an additional 24% spending. Now, you know, I was in London and actually in May, and what I found very interesting, there was a tremendous amount of talk about the ministers and how they had been taking home all these payments and paying for duck ponds and all this ridiculous malarkey. But the other major news article was the fact that actually there's a major undersupply of property in cities like London, and they really need to sort it out. And the government understands these problems. So this is not salesmanship. This is not marketing. You need to understand these fundamentals. And with the economic crisis, they're actually expecting this year to only bring 60,000 homes to the market. The fundamentals of supply and demand just continue to get further and further out of kilter. And you as an investor need to understand how important this is to your investment opportunity in the UK. In terms of strategies for investment, when you look at London versus the rest of the country, London statistically has more growth and it has more tenants. And I think something that's very, very important is that, yes, you can go to Manchester right now and get 50 or 60% discounts off the purchase price. I promise you, you'll talk to me for a week, and then after a year, when you haven't had a tenant, you'll come looking for me with a baseball bat. Be very, very careful where you invest, particularly outside of London. And I think it's actually summed up by this quote by CNN, which I saw last year. New York is the center of the Western world, and London is the center of the rest of the world. You know, you really need to understand the significant importance, the size of London, the demand for accommodation, and also statistically, if you look over the last 30 years, London has outperformed anywhere else in the country with regards to capital growth. And that is so important as an investor to look at the long-term averages. The other thing that's very interesting to take into account with London is that you can break it down into 3 sectors. So you've got your primary areas, areas like Chelsea, Holland Park, Belgravia. You've got your secondary areas, Kennington, Whitechapel, Bethnal. Some areas you might recognize there would be Barking, Greenwich, Wimbledon, Earlsfield, and then you've got your sort of tertiary areas, your Lewisham, your Archways, and your Brixtons. And you can see again over the last 30 years, statistically, London, the secondary areas have actually performed the best with regards to capital growth. And I'm going to show you that not only capital growth, but also rental return and yield gets the best return in the secondary areas. And that is why we focus on those areas. To give you an example of this, this picture here is a picture of Canary Wharf. That there are the Canary Wharf Towers. It's the financial capital of London. It's the financial capital of Europe. And it's arguably the financial capital of the world. The statistics that come out of there are phenomenal. Yes, it's been hard hit by the economic crisis. It is the financial hub. But that is where the heartbeat of London, the financial sector, is. And the interesting thing is that property prices right in that heartbeat there average from about £800 to £1,000 per square foot. Ladies and gentlemen, that's about 150,000 Rand a square meter, just to put it in perspective. Now that's a classic example of a primary area. A secondary area here is Greenwich Peninsula. Now this is a new development. That there is the Millennium Dome, 175 concerts a year there, 52 restaurants including a Nando's and a Spur. And the important thing is that there is the tube station right there. It's one stop on the Jubilee line, which is the new line, straight into Canary Wharf, 2 minutes away. So it's literally on the doorstep of the financial hub. And yet property in this area actually goes for around £496 a square foot. This is one of the biggest regeneration areas in the whole of Europe. There's £10 billion being spent here with regards to residential, retail, commercial, there's shopping centers, there's even universities and schools going into it. And this is a classic example of one of those secondary areas where one can experience above average growth in the foreseeable future. In terms of tenant demand, you can see from this graph that nowhere else in the UK even compares to London with regards to tenant demand. And you know, it's not just the British. There's South Africans. There's 750,000 South Africans that live in London. 1 in every 11 Londoners is a South African. We're the biggest ethnic community after the British in London now. But you know, it's not only the South Africans. It's the Aussies. It's the Kiwis. It's the Americans. It's the Europeans. It's the Polish. Everyone wants to come to London to make their fortune. And the important thing is that it's a very transient population. They want good furnished accommodation. They generally don't have money to actually buy property or not going to stay there long enough. So if you can give them good quality accommodation, close to their place of work, close to their place of transport, you've got very good tenant demand. And I'm going to go a little bit more into that tenant demand later because, you know, with regards to the retrenchments, it is something that one needs to take into account and something that one needs to understand. In terms of what will happen in the future, there's two sayings here that I love. Warren Buffett said, I've never had the faintest idea what the stock market is going to do in the next 6 months, the next year, or the next 2. Clem Sunter, someone a bit closer to home, when he was asked about the gold price, said it will go up and it will go down, but not necessarily in that order. And as Ian Fife said, the only thing that you can be sure of at the moment is uncertainty. But I think the important thing is that a lot of people, the property market is cyclical. It always goes up and down like this and it always has in the past. But what people tend to do is focus on this area, and they focus on graphs like this. They start to panic. They start to miss the opportunities. They start to forget about the fundamentals. They start to forget about the supply and demand and the income potential and the cash flow positive properties. And to give you an example of what I mean by this, that's a picture there of my first house. That house there is in Wimbledon, about 5 minutes from the station. I've bought that. Touch wood, I've never had a day's void since the day I bought it. Now, ladies and gentlemen, you might look at me and you say, why am I showing you that example? The reason I'm showing you that example is that everyone looks back. I bought that house in the beginning of 2002 with my business partner. Now, at the time, we just had September the 11th. England was going to war with Afghanistan. Oil prices were going up. Inflation was going up. And my mates said I was absolutely mad. They said the property market is going to collapse around you. My business partner and I found that property. We did some renovations to it. We stuck 5 South Africans in it, and the rent covered the mortgage with a nice buffer, basically. And I said to my friends and to my business partner, guys, this is an income investment. It's cash flow positive. And even if the market were to go down, we're going to ride out this wave. Well, you know, in hindsight, you look back now, 7 years, we were very lucky. The fundamentals really worked in our favor, and that property has more than doubled in value. But the important thing is going back to that cash flow. I'm an income-based investor, and that is what I focus on. That property now, a year ago, our mortgage was £1,750. Our rental is £2,400 a month. Ladies and gentlemen, today our mortgage is £425 a month. Now you as an investor only need to get yourself 3 or 4 or 5 of those properties and you can properly set yourself up for life. And that for me is the focus of this presentation. And really there's fantastic opportunities now, but you need to focus on that income component. In terms of that income component and that cash flow, I've basically got a document here from Find a Property, and it's their rental index for June. Now again, it's on our blog if you want to go and read the full report. It's about a 15-page report. I took out some of the pertinent bits. In June 2009, rents increased for the first time since August 2008, demonstrating further signs of recovery in the UK rental market. Supply levels of rental property actually fell by 0.4% in June. Asking rents in London remain volatile, declining by 0.3% in June after a month-on-month increase of actually increasing in May. The average in the capital now stands at £1,625. The average rental yield in London is 4.74%, and investors are continuing to receive better returns in London's outer boroughs, especially areas undergoing extensive regeneration. Ladies and gentlemen, I just want to reiterate that. I've already shown you statistically over the last 30 years that the secondary areas outperform both the primary and the tertiary areas with regards to capital growth. Well, here from a cash flow point of view, the secondary areas also outperform those areas with regards to your yields and your income return. It's black and white and statistical. Overall, rental prices have fallen by 8.5% from peak to trough, and only 3 boroughs, Barking and Dagenham, Hillingdon and Greenwich, have shown positive returns over the last 12 months. The average yields of over 6% can be found in Barking and Dagenham and in Newham. And it's no coincidence that IPS has been helping people invest in Barking and in Greenwich over the last 3 months. Something that's very interesting, and I just want to bring it up here, it continues to be the prime areas of central London, Kensington and Chelsea and Westminster, the most affluent areas of southwest London, including Richmond-on-Thames and Wandsworth, where they're getting the lowest rental yields. Kensington and Chelsea have only got sub 4% now, 3.92%, with the city of Westminster being 4.12%. Those is a classic example of those primary areas and what's actually happening. Another important element that's been taking place is that there's been a huge increase in demand for London property from overseas investors. An example of this has been Hong Kong. Over the last 6 to 8 weeks, a lot of property has been sold. One developer, St. James, went out to Hong Kong and sold 86 units in a day. And the reason they're doing it is because of the weakness of the sterling, and also because overseas investors have always been able to borrow around 70%. They can still borrow around 70%. So they're taking advantage of the great asset values, the very good income yields, and also the weakness of the sterling. And I think they're also taking a medium to long-term view, understanding the fundamentals and making those investments. Over a third of property transactions have been to international people in the last quarter, and IPS has helped a significant number of investors invest in London in the last 3 months. When one looks at it and why South Africans are investing, if you take the last 15 years, if you'd invested the exact same amount of money in South Africa or you'd invested the exact same amount of money in the UK, there's been 400% growth in South Africa and only 182% growth in the UK. But you would still have 240% more money if you'd invested in the UK. Now let's look at some of these numbers. I'm just going to quickly go between and go to my Excel spreadsheet here. Sorry, let me just move you across to that spreadsheet. Right, so you should now all be on the Wimbledon cash flow. I'm just giving you an example here. I'm not going to spend too much time on this. It is quite important though, and certainly is available for those of you if you want to meet up with myself or my business partner or any one of our property professionals. But basically we're working on a 70% loan to value. You've got the rental there, you've got the interest rate at around 4%, you've got the purchase price at 232, you've got stamp duty, there is no furniture because it comes included with a furniture pack. You've got your legals and finance fees, The nice thing in the UK is that there's a lawyer that acts on behalf of the buyer and a separate lawyer that acts on behalf of the seller. So you are completely protected from a legal perspective in terms of it. Your lettings and management at 12%, and I've worked on an exchange rate of 13 Rand 50. To buy this property outright, you effectively need £78,000. The next block basically gives you the cash flow of when that's actually due. It gives you the pound component and also the rand component. And you can see there in terms of the timing. Now, the reason this one is particularly quick is because it's actually ready now. It's finished. It's actually tenanted. We've got projects with a 2-year lead time where you only have to put down 2.5% now, 2.5% in 6 months, and 5% in 12 months, with the remainder only being paid in 24 months. So we've got something for everything in terms of long lead times. The important thing is that if you take this property's income minus all the expenses, you will actually see that it's cash flow positive from day one. And it's nicely cash flow positive. I mean, you're looking in the region of a couple of £100 per month every month. And that, for me, is one of the most fundamental things that you need to be focusing on as an investor. And then lastly, in terms of returns, I don't have a crystal ball better than anyone else. But if you take a 5-year view and you use 3 scenarios, 3, 6, and 9, the reason I use 3, 6, and 9 is because basically the 50-year average is around 9%. Property tends to track inflation, and the 10-year average for inflation has been 3%, and 6% is somewhere in the middle. At a 3% capital growth over 5 years, you're looking at making an 11% return on your money year on year. Now, that's not fantastic, but it's a hell of a lot better than it is for a lot of people who have their money just sitting in bank accounts. And you know, this is in property in a high demand area in the Wimbledon precincts, and really 11% return is quite good when one considers how conservative one's being over the next 5 years with a 3% capital growth. Considering the huge discount, you're buying this property at about a 30% discount, so there's a huge opportunity for uplift. But the important thing is that the rand statistically is devalued by about 5%. So if you add that 5% to that 3%, because if I have £1 million and I invest here in Sandton, or I take my £1 million and I invest offshore, comparing apples with apples, I'm now making a 30% return year on year. Ladies and gentlemen, that's not a very high capital growth prediction, but a 30% return year on year. I would challenge you to find that elsewhere in terms of opportunity, basically. So if I go back to the PowerPoint presentation, you can see there, this is a graph, and I just wanted to show you. It's something that I'll run through with you if you meet with myself or one of my partners. But ultimately, the idea is, ladies and gentlemen, is to build up 3, 4, 5, 50, 500 cash flow income producing properties that are netting you a fantastic return each and every month. And you know, once you've got yourself, this is just an example of one property here on this particular spreadsheet, which, you know, this property is actually going to be netting you in the region of £29,000 in terms of having this portfolio, and that really is a substantial amount of money that people can live off. And as a retirement fund, when you consider that this particular property, in terms of the return, will have in the region of around £397,000 over 10 years, you know, and that's only working on an 8.5% capital growth, where the statistical average is 9% over the 50 years. But it just gives you an idea. That's what I'm doing. That's what myself and my business partners are doing in terms of accumulating assets. We focus on the income, and as long as you're investing in the right areas, the capital growth will come. To give you some examples, this is an example of a building which is in that North Greenwich precinct. It's right on the Thames. It's got beautiful 180-degree views up and down the Thames. It's also starting to construction on the 3rd of August. It's going to take 24 months to build, so it's 2.5% deposit now. It's 2.5% in 6 months, and then a further 5% in 12 months. 2 years to build. There's a 12-month rental guarantee at 6%, which basically takes you right through to the middle of 2012, which is when the Olympics are going to be. And the important thing here is that there's also a 26% discount on the price between 2007 and today's prices. Another one is an example. We had an area called Barking. Now, this is right next to the Olympic Village. Do you know that in 2008 you could buy a one-bedroom there for £197,000, We've been helping people invest in that for £146,000. The 2 beds were going for £239,000. People bought them at that price and they were valued at that price. Now they are selling for £169,000. That's a 35 to 41% discount. And you know the important thing is there, I've shown you statistically, Barking is the best performing rental growth area in the whole of London out of 34 different precincts. This is where you get both the advantages of income and you're getting it off a discount. And because of that, you know, a lot of people didn't believe me. That property went to a fire sale. There were 35 units available and they sold 47 on one day. And you ask me how they sold 47. They managed to persuade another seller to sell more units because there were so many people at the launch. And lastly, here's a picture. This is that building where we've looked at the cash flow. This here is actually of, it's called the Sanctuary. It's not quite Wimbledon. I've done it myself. It's about a 16-minute walk. It was built in that node. And the nice thing is it's between 3 stations, Wimbledon, Earlsfield, and Southfields. This building is finished and it's fully tenanted. And I think, you know, in terms of demand, the important thing here is also the discounts. In 2008, you were buying a 1-bedroom unit there for £200,000 and a 2-bedroom unit for about £320,000. In 2009, you're buying a 1-bedroom unit for about £150,000 and a 2-bedroom unit for £236,000. And you know the yields are in and around 6 to 7%. This is really good value for money. And the important thing is there's a development right 5 minutes from Wimbledon Station. Do you know, a year ago, the 1-bedrooms were selling for £350,000, the 2-bedroom £450,000. It shows you the real value that you're actually getting here. I want to show you some pretty cool and funky technology quickly. A lot of South Africans haven't seen this. This here is Google Earth, as you're all aware. But the important thing here is I'm going to zoom in now into Wimbledon. And I'm sure, you know, a lot of you haven't seen it. We actually had a client yesterday who came along and said, oh, look, there's the site. It's all looking bare. Are you guys actually lying to me? But the beauty with Google Earth now is you can actually go into it, and I can see exactly what it looks like from the street. So, you know, why get on an airplane and fly all the way to London when I can take you and show you? That, ladies and gentlemen, is exactly the building. There's the picture. There's the road. You go down that road to get to Southfields. You go down that road to get to Earlsfield. And if I want to spin it all the way around, you go down that road there to get to Wimbledon. So I just thought that was some absolutely fascinating technology, and I really just wanted to share that with you, basically. Okay, so let's get back to the presentation here. Okay, righty-do. Okay, in terms of the end-to-end solution, IPS has been helping people invest internationally for 6 years. We've helped over 1,500 people invest internationally. We provide you with a full end-to-end solution. So with regards to financing, we deal with a gentleman called Mike Abbott from Sable Wealth. He's a South African based in London, and he really does assist and has tremendous experience in helping South Africans get good mortgages, whether you're living in London or overseas. In terms of offshore structures, we've got Philip Verveers. He's a South African. He's currently doing his PhD in international tax and structuring. He used to work for Trevor Manuel and is one of the most experienced and educated people I've met with regards to setting up offshore structures. You need to go and see him and speak to him, but if you do it right, you can actually save on income tax, capital gains tax, and inheritance tax, and it's the most tax-efficient way, particularly of buying. And he can also help people take more than their R2 million offshore allowance out the country legally. In terms of the process, you sign you basically pay a R20,000 reservation fee and sign a reservation form. We then arrange the full exchange with Mike Foss, who's the attorney in London. He's helped thousands of South Africans invest in London and fully understands the process and is fantastic. We've got foreign exchange experts that can help you move money overseas and also arrange your exchange control approvals to get your deposit. And then from our side, as I said to you, we provide you with a full end-to-end solution, helping you manage the entire purchase right through the process, right through to the management. And it really depends on where you're looking around the city. We've got different bespoke experts in different areas. For an example, in the Canary Wharf area, Life Residential, Jonathan Worth, they've got about 1,800 units under management, and they really specialize in that area. So, you know, we really, as a company, help you invest with confidence. And that for us is the most important thing. In terms of what you're looking for, I asked you up front what different people are looking for. We can really help you find anything. We can help you find investment apartments. We can help you find individual homes, repossessed homes. We can help you find homes that need to be renovated. We can negotiate on bulk discounts with developers, for example, 8, 10-unit developments. And we've even got people that can find commercial opportunities. So, you know, really whatever it is you're looking for, whatever your criteria is, myself or one of my team will be able to understand that and provide you with a solution. There's an Afrikaans saying, and I'm a Durban boy, so bear with me, ver van jou goed, nou aan jou skade. You know, basically a lot of people are very nervous to invest offshore. You need to come in, you need to get the research off us. We help you understand the opportunities, and then we provide you with an end-to-end solution, helping you right through the process so that we can let you take advantage of these offshore opportunities so that you don't miss them. To answer the question I asked right in the beginning, why is this the best time since 1991? There's a recent report that's come out by Knight Frank. They believe the market will fully recover by 2012. The fundamentals are in place, and it merely is the banking mechanisms coming into the market and lending. At the moment, I showed you that from the statistics, peak to trough, you're looking at about a 15% drop in the property market. You're getting discounts in the region of 26 to 40%. You know, even if the market loses another 4 or 5%, you've still bought significantly below market value. And then lastly, the Rand. The Rand is very strong at the moment. And this is actually summed up by an RMB report which came out in June, where they basically said, reflecting on what they see happening in the market, their medium-term view of the South African Rand is not that good, basically. They expect the US dollar to South African Rand to be around 9 Rand by the end of the year, and by the end of 2010 to be trading around 10 Rand to the US dollar. They basically finished off and they said, if you're looking to invest offshore now, now is the time to do it. Ladies and gentlemen, I'm going to reiterate that. If you're looking to invest offshore, now is the time to do it. So, with the saying from Van Gogh, whatever you do, hang on, let me start that one again. Whatever you do or dream you can, begin it. Boldness has genius, power, and magic in it. Begin it now. Ladies and gentlemen, the one thing that I've found is that most people that retired in property made their fortunes between 1989 and 1992, and then as the property market recovered. And mark my words, there are hundreds of people, thousands of sophisticated investors who are taking advantage of these opportunities. And I really believe that you too need to understand these opportunities and be looking to get into them. So in conclusion, I see I've made a mistake there on my presentation. The British Lions were very successfully beaten by the Springboks, which I'm very proud to say I was at all 3 games. That is actually meant to read, if you go to our website, we're now giving away 2 tickets to the World Cup Final 2010 next year. I think it's going to be one of the most fantastic opportunities for South Africa to really showcase itself to the rest of the world. We're also on Twitter. If you go to, I'll send that out quickly, twitter.com/IPS invest. Basically, ladies and gentlemen, that there is, 2 seconds, I just need to go back. What you basically got with regards to Twitter, a lot of people don't understand Twitter, and you know, it's really is fantastic. I've only been on it the last couple of months, but I think the important thing is, and if I just show you here quickly, you can follow really up-to-date information. So this is what's known as a tweet deck, and basically you can follow, and I mean, I can go through, I don't follow up and sign up to everyone, but if you just look at some of them, you know, okay, I'm following Bob Skinstad, that's a bit of humor. I've got Tony Robbins here, a daily quote, it keeps me up to date. I've got property people, unemployment. I've got things with regards to the UK market, the Australian market, and I obviously update this both in my personal capacity, Scott Picken, and IPS Invest, my business partner does it. It's a fantastic way of keeping you up to date as to what's happening in the market. And then finally, and just not to be forgotten, all our information is on ipsinvest.com. I have recorded this presentation. It will also be there. So, you know, ladies and gentlemen, that's everything from me. I hope you've really enjoyed this presentation. I hope I've answered, you know, many of your questions. I really and truly believe that now is one of the best opportunities we've ever seen, certainly in our lifetime, to get into the market. And I'd like to sort of open the floor now to those of you if you've got any questions. Is there anything from anyone that I haven't answered? Please let me know with regards to the questions, and I can actually run through them for you. Okay, I'm not getting any questions through there. I tell you what, let's get a bit of crowd participation going. I want to launch a poll there as to how much money you would like to invest in the UK, and it sort of gives you a breakdown there. If you want to click in, you can tell me what it is you're looking for in terms of the amount of money you would be looking to spend in terms of an offshore investment. Okay, it looks like a lot of you have voted. Let me just see there. Is anyone else? Okay, right. Let's close that poll. If you're interested, I'll just share those results with you quickly, and you can actually see what it is people are looking for. And then lastly, just before I finish off, I want to ask you one last question. If we were to bring a fund to the market, would you be interested in something that was looking at below market value properties, where effectively you could invest as little as £10,000 and we would go out and buy 20, 30, 40, 50 units? Or would you be looking more at commercial opportunities? Okay, very interesting. We've got a mixture of what different people are looking for. I can see there we've nearly got everyone in terms of the voting. Okay, right. Let's close that poll, and I'll show you those results just so that you can see. Quite interesting, basically, in terms of what different people are looking for. Okay, ladies and gentlemen, well, that's basically all from me. I would like to just find out from you in terms of if there are any questions, please let me know. Otherwise, I'm going to sign off for the evening. So let me just see there. I'm seeing I don't have any questions coming through. That's either means two things. I've either bored you to death or I've answered all your questions. Okay, right. Well, I've got no questions coming through, so I'll tell you what I'm going to do. If you want to get hold of us, please contact us. All our contact details are on the website. We've got people based in London. We've got people based in Cape Town, Durban, and Johannesburg. Please give us a call. We're happy to sit down with you. We're happy to understand exactly what it is you're looking for. And once we've done that, we can then effectively help you find a solution for you. So without further ado, have a fantastic evening. Thank you very much for your time. Good night.